Nick Fenton here, back with part 6 of our short Strangles strategy criteria video series. And part 6, we're talking about exit criteria. How do I determine when I want to exit? Very simple discussion. Generally, as often as possible, I want a 25% decay in the credit. So a 25% credit decay. But then I'll automatically take profits. Max credit decay that I will require is 50%. If I'm in a position where a 50% credit decay or value decay, whatever you want to call it, is not or does not produce a solid net profit, net of commissions, then I pass on the trade. So we've been looking at this UNG position, and let's just apply those principles to this particular scenario. So we determined a 55-cent credit on entry. And if we're looking for a 25-cent value decay, where would we cover the position? And what would that result in on a net of commissions perspective? So let's go back to the calculator over here. And so we've got 0.55, and I just multiply it by 0.75. So the number here is going to be what we cover at. So you'd be covering at about 41 cents. That would be your cover order. And that would represent about a $14 gain. So you simply just say 41 cents minus 55 cents, so 14 cents. So 14-cent gain, or $14 per spread. If you really just don't want to do the math, you want to kind of just be lazy, you can say 0.55 times 0.25, and so you get about 14 cents, like I said, per strangle. So let's say your commissions are $1.50 and you have no flat fee, $1.50 per contract. A strangle consists of 2 legs, so per strangle you've got $3 in commissions on entry, $3 commissions on exit. That would be a $6 round trip commission. And in this situation, if you did take profits after a 25% value decay, then your profit net of commissions would be 14 minus 6, which is 8. So is $8 a reasonable profit objective? In my opinion, no. I would not be happy with an $8 gain. So what you have to do is say to yourself, okay, what is a reasonable profit objective? So let's just take a look at this and say, okay, if we were to get a 50% value decay, what would that translate to from a dollar perspective? So a 50% value decay, we'll just call it 28 cents. So say we cover at 28 cents for a 27-cent profit. So $27 per spread, deduct that same $6, and you've got a $21 net of commission profit. That's a pretty reasonable objective, I think. It's not, you're certainly not crushing it by any means, but I'd say that's a pretty reasonable objective. 50% value decay. We're here at very high implied volatility levels in UNG, and I think it would be pretty realistic to cover at a 50% value decay within a 2-3 week period. I don't think you need to hold your entire, much longer than that to achieve this profit objective. Could be wrong, but that would be my guess. So let's just say that I decide, okay, 25% value decay is not going to cut it. That $8 net of commission profit just isn't going to do it. But the 50% value decay, I'm okay with. It's $21 net of commissions, assuming $1.50 per contract and no flat fee. What I usually do is I'll go to create duplicate order, and I'll automate the profit taking process. I never put stops on my options trades, but I will automate taking profits. So I'll never automate taking losses, but I will automate taking profits. And in order to do that, we hit create duplicate order to get to this screen, and go to on the advanced orders area, change it from single order to first trigger sequence, and you simply right click in the trade here again, hit create opposite order, and that brings up your buy order here. So once this top order fills, selling to open the strangle at a 55-cent credit, it's going to trigger this bottom order to start working. So the first thing you want to do is change this to good till cancel, because you want that to just be resting in your working orders area. And then we'll go over here and we'll change this to the 28 cents debit that we mentioned. So essentially what this is saying is we're working in order to sell a strangle in the amount of 35 contracts. We got the 35 number when we did our allocation calculation in part 5. This is the underlying is UNG. We're using Feb 2014 options. The strike on the call is 26. The strike on the put is 18. So we're selling the 18 put, selling the 18 or 26 call rather, and we're doing this for a total credit of $55 per strangle. That is a limit order. It's a day order, so it expires at the end of today's trading session. And we're doing this. We're not choosing a specific exchange. We're just going to route it to all the exchanges, and whichever has the best offer is going to we'll fill at the best exchange. So whoever's willing to fill it. And as soon as this triggers, this order fills, then you will get an order to buy to cover at a 28 cent debit, which would achieve that 27 cent gross gain. Deduct the so 27 bucks per strangle. Deduct the $6 round trip commissions, and you got $21 net of commissions. You're working that at a limit order, and that is good till cancel, so it's just going to stay resting. I noticed here in the mid-nat spread that this has reduced in value, so I'm not sure we'll fill at 55 cents, but let's just go ahead and do it. We're in paper money, no big deal. Hit confirm and send, because I want to show you guys how this works. So we'll go over here to the monitor tab. You can see it's currently working the strangle at 55 cents, and the mark is 53 cents. So for the sake of getting a fill, let's hit cancel replace order. So I just right clicked on that top trade, cancel replace. I'm going to unlock, so it's going to change it to the mid price, and I'm going to hit confirm and send again. So we confirm and send, hit cancel, and let's see if we can get a fill here. Come on, baby. No fill, it's still working at 53. So cancel replace, and we'll move it to 52. I don't usually do this, I usually wait, but I just want to get this thing filled. Alright, so cancel replace, and you hear it filled. So we just sold 35 strangles in UNG at 52 cents. And if you go back here to your monitor tab again and look at activity and positions, what you can see is under working orders, we've got this order working to buy back 35 of the strangles we just sold in UNG on the Feb 14s, the 26.18 strangle at 28 cents. Currently, the mark on that is 53, and you can see that under filled orders, we've filled this particular trade just a few seconds ago, and it tells you the details. So we filled it at 52 cents was our net price. So now we have this automated profit-taking order working up here. This position just continues to work itself, and if it does get down to that 28 cent debit, it'll just automatically fill. Doesn't matter, you can be out on a golf course, you can be at a lunch meeting, you can be doing whatever you're doing if you're not looking at the market, and you'll automatically your profits will be automatically triggered. So it's a very, very good practice to do. I do this on every single trade that I make. This is a low credit, but if we were to sell a strangle in a higher priced underlying, the price of UNG is 21 bucks, so you're not going to get an extremely high credit selling a way out of the money one standard deviation plus strangle in a $21 underlying. But if you do it in a $100 underlying or $300 underlying, your credit's going to be pretty substantial. And let's say you have a credit of, let's say you have a credit of a buck, double what we had here. A 25% value decay may be a reasonable profit objective because you'll be covering it at 75 cents for a gain of $25 per strangle. Net out the $6 commissions, and you have 19 bucks per strangle. What this does is essentially we're in a very high theoretical probability of success trade, and it increases your probability of realizing profit when you're only requiring a small amount of profit before you're willing to take profits on the trade. So I like to look at it as edge on edge. You have edge, you're giving yourself edge by having a theoretically high probability of success, and then you're giving yourself edge on top of that edge by only requiring a 25 to 50% value decay before you're willing to take profits. So it's a really good practice to make. This is what I do. It dramatically increased my trading results when I started doing it, and it's significant. And another final note is, another reason I do this, not only does it give me edge on edge and gives me a higher probability of actually realizing profit in a high theoretical probability of success scenario, but it also unlocks the buying power effect. So I get that buying power back that I can put towards something that has a little bit more juice in it. So I'd say I've been in this UNG Strangle for 3 weeks. It's been locking up $3,500 or $5,000, whatever, and in buying power effect. But there's only another $20 or $28 to be made in it, whereas I can take that $5,000 and I can move it into something else that has a much higher premium built into it, much more juice, much more theta decay potential. I can do more with my capital, so just keep on flipping, and moving. That's the way I approach it, and you should highly consider doing so yourself, but at the end of the day, it's up to you to do however you feel like it doing it. So, hope you found this informative. I'll see you in part 7. I'm just going to have a brief conversation on, in the rare case that I do make adjustments in a strangle, the way I approach it.